Welcome back to Simple Mind Space. Today, we're diving headfirst into a topic that might seem a little daunting at first, but bear with me, because understanding it is like unlocking a hidden superpower in navigating the world around you. The fascinating, intricate, and sometimes baffling story of money, how it's created, how it moves, and why it even holds value in the first place. Imagine this: you have an apple, and I have an orange. We both want what the other has, so we trade. Simple, right? We're both happier because we got what we wanted. Now, let's say you have an apple tree laden with ripe fruit, and I have an orange tree that won't be ready for another month. You could give me an apple now, and I could promise to give you an orange when mine are ripe. Again, a win-win situation. But here's where it gets interesting. What if you don't want an apple? What if you want a pear, and there's a third person with a pear tree who's willing to trade a pear for an apple? Now we have a three-way exchange. Add in more people, more types of fruit, different harvest times, and suddenly it becomes difficult to keep track of who owes what to whom. To simplify things, we could create fruit credits, tokens that represent the value of our fruit. Trade an apple, get a credit. Want an orange? Trade your credit. This system allows us to exchange goods and services without worrying about the logistics of bartering every time. As our system expands to include more goods, vegetables, tools, you name it, those little fruit credits start to feel like they have value themselves, even though they're just representations of the actual goods. But because they can be reliably exchanged for those goods, they gain real-world purchasing power. Now, imagine someone starts a business offering to store your valuable fruit credits for safekeeping. Maybe they even offer to pay you a small amount to keep your credits with them. It sounds a little strange, but you decide to trust them and deposit your credits. Meanwhile, our successful watermelon farmer needs to expand her operation to meet the growing demand for her delicious melons. She needs more fruit credits to buy a new irrigation system. Our new credit storage business sees an opportunity. They offer the farmer a loan, giving her the credits she needs today in exchange for a promise to pay back a slightly larger amount later. The farmer is happy because she can now grow more watermelons. The credit storage business, let's call it a bank, shall we, is happy because they stand to earn more credits through interest. And you're happy because your deposited credits are still available for withdrawal, even though the bank has lent some of them out. How is this possible, you ask? This is where the magic of fractional reserve banking comes in. The bank doesn't need to hold on to every single credit that's deposited. They only need to keep a fraction on hand, a reserve, to cover any withdrawals. The rest, they can lend out, effectively creating new credits in the process. Think of it like this. You and a roommate share a blender. There's only one physical blender, but both of you benefit from its use. In essence, you're extracting two blenders worth of value from a single blender. Fractional reserve banking operates on a similar principle, except we're talking about money instead of kitchen appliances. Now, I know what you're thinking. Isn't this creating money out of thin air? And the answer is, in a way, yes. When the bank makes that loan, new credits are injected into the system. This is why it's so difficult to pinpoint exactly how much money exists at any given time. Different definitions include various combinations of physical currency, checking accounts, savings accounts, and other financial instruments. The key takeaway here is that money is created when it moves, when it flows through the system via loans, investments, and transactions. Sitting idle, it doesn't generate more of itself. But the easier it is to move and exchange, the more efficiently it can work its magic. This brings us to the evolution of money itself. It hasn't always been digital transactions and lines of code. Centuries ago, physical currency, coins and the like, reigned supreme. But as economies grew and transactions became more complex, we needed more efficient ways to move value around. Enter the check. It revolutionized transactions, allowing for the transfer of funds without physically exchanging gold or silver. Instead of lugging around bags of coins, you could simply write a check, and the recipient could deposit it at their own bank. It was a game changer, but it still relied on a complex network of banks, clearinghouses, and physical transportation. The introduction of computers like IRMA in the mid-20th century further streamlined the process, automating what was once a painstaking manual process. Checks could be sorted, processed and reconciled with greater speed and accuracy than ever before. But paper still had its limitations. The real revolution came with the advent of electronic funds transfers and networks like the Automated Clearinghouse, ACH. Direct deposits, automatic payments, ATM withdrawals, these innovations transformed how we interacted with money. Transactions became faster, more secure, and far less reliant on physical pieces of paper. On the international stage, SWIFT emerged as the backbone of cross-border payments, connecting thousands of banks worldwide through a standardized messaging system. Now, businesses and individuals could send money across oceans with relative ease, facilitating global trade and commerce like never before. And as technology continues to evolve, so too does the world of money. Fintech startups are disrupting traditional financial systems with innovative solutions like Wise, offering faster, more cost-effective international transfers, particularly for those who rely on remittances. The blockchain and cryptocurrencies represent another leap forward, introducing decentralized digital currencies that operate independently of traditional banking systems. While still in their early stages, they hold the potential to reshape the financial landscape as we know it. But for all the innovations, at its core, money is still a form of accounting. It's a system of trust, a promise that those credits, those digital entries, represent real value that can be exchanged for goods and services. And like any system built on trust, it's only as strong as the mechanisms that ensure its integrity and reliability. So the next time you swipe your credit card, send money online, or even just pull cash from an ATM, take a moment to appreciate the incredible journey of money, from those humble fruit credits to the complex, interconnected digital systems that power our global economy. It's a story of innovation, ingenuity, and the enduring human desire to connect, exchange, and build a better future. And that brings us to the end of today's episode. I hope you found this deep dive into the world of money as fascinating as I do. If you enjoyed it, be sure to like, subscribe, and share this episode with your friends. Until next time, keep those curious minds engaged, and we'll see you in the next episode of Simple Mind Space.